Good evening to all of you, friends. I hope you have been okay, your families have been okay in this very difficult period. It's nice to connect with all of you after a gap. I will be sharing few slides from the yearbook, and as Ashok said, it would be very difficult to go through each and all of them, but some of the key slides I plan to share with you today, and then after this, I am happy to answer any questions or thoughts that you may like to share. So as this cover slide of the yearbook itself implies, every storm runs out of rain, just like every dark night turns into day. The last 2 years have been extremely challenging, not just for India, but for the whole world. But I think most expert advice suggests that we are nearing the end of this extremely difficult period. This period was particularly difficult for the low-income households world over and also in India. The economic impact was, however, less, and the reason for this is that the aggregate purchasing power of the low-income households is actually quite small. In a way, that is unfortunate, but that is one reason why the economies world over have bounced back very strongly. And of course, the central banks, the governments have done their bit. Interest rates have been cut, fiscal deficits have gone up, spending has been increased on infrastructure, significant income transfers have taken place world over to low-income households. And as of today, the world GDP is back to where it was pre-COVID levels. I think the economic output has completely recovered. But before I go on to that, let me share with you this. I think this slide I would like to start off with, and I think this slide has some important lessons for us. How dramatically things can change, sentiment can change in a short period of a year. This is one of the key slides, opening slides of the yearbook, and it contrasts the headlines in 2020 of pessimism, of despondency, and the headlines in more recent times, which are far more optimistic and positive. I think the lesson for this year is that conditions can change pretty rapidly. And I think there is a lesson in this for investors also, that when markets are deeply pessimistic, it is that when you get the best opportunities to invest. And this is what happened this time around also. And some of you may recall our calls over last 2 years. I think we were right in calling or being in optimistic on the equity markets right at the peak of the pessimism. And it is for this reasons that we have often said that the best investment opportunities are often found in the most difficult periods, and vice versa. The now coming back to the economy, I think the economic outlook has been clearly, it has recovered, but the world has paid a price for that. And what is the price that has been paid? The price that has been paid is by way of much higher fiscal deficits and much higher levels of debt across the world. And I will share with you some numbers. In US, the sovereign debt pre-COVID was 110% of GDP. It has gone up to 130% of GDP. Likewise, in Europe, it has gone up from 85% to 100% of GDP. So world over, in a short period of 2 years, the debt levels relative to the size of the economies have increased in the developed world by nearly 20%, a very big increase indeed in a very short period of time. Let me now move on. And so I think as things are coming back to normalcy, what is the economic outlook going ahead? I think we expect growth to normalize for the world economy. And there are three key points that I would like to highlight. If you look at the chart at the top, you will see that the durable goods and non-durable goods are meaningfully ahead of pre-COVID levels. But the activity or consumption around services is still lagging for very obvious reasons, because many of the services need stepping out, contact, etc. So services is what has really suffered and is yet to recover. And this was also one key reason why the urban poor, who are mainly employed in the services segment, have suffered deeply in this period. I think the as economy opens up, as services also pick up, I think it should support global GDP growth going forward. The second positive factor supporting growth in the future is the accumulation of excess savings across countries. And the chart in the middle tells you, because savings rates have gone up, expenditure was low, and also there have been income transfers from the government. So households are sitting on excess savings. And as things open up, as the service economy opens up, some of these savings will be put to use, and that should be supportive of economic activity moving ahead. The third thing that should support economic growth is the focus of governments world over on reviving capex, on improving infra investments. And it is estimated that in the period 2022 to 26, investment should be around 27.5% of world GDP, which will be higher than both pre-GFC and pre-COVID levels. So I think these are three factors that should support faster economic growth going ahead. What are the negatives? I think clearly the fiscal deficits that have been extremely high in last 2 years, the debt levels that have gone up very sharply. I think these have to normalize. The monetary and the fiscal stimulus has to mean revert. And this, I think, will pose some challenges or headwinds to the global growth. Let me now move on. I think this was a period where we saw extremely strong returns across asset classes. And it is interesting to note that it was the third consecutive years of double-digit returns from S&P 500 and MSCI World. And we think, given the extremely low level of interest rates, very high levels of liquidity, high savings rates, all of these have favorably impacted the world market. And you can see in the two charts at the bottom that the world market cap to money supply and world market cap to GDP ratios are touching lifetime highs. So I think there are reasons to be cautious on the outlook of these markets, because the currently extremely low level of interest rates are unlikely to sustain for long. And as these ratios are clearly sitting at an extreme, while we are not an expert on the world markets, I think there are reasons to have moderate expectations. I think one factor which I would especially like to draw your attention to is what is happening around inflation and wage inflation. Some of you might have observed that the narrative around world inflation, which banks were initially saying is transitory, and then it has moved to transitory for longer. And now people are debating whether it is really transitory. And you can see the retail inflation in the US has gone up sharply. The US job openings have gone up very sharply. And even the US wage inflation is pretty robust. I think the reasons for this could be very simple. After Lehman, for the last 7-8 years, the investments have been weak generally. So the world has not invested enough in capacity creation. And on the other hand, in the last few years, there have been significant income transfers. Interest rates have been extremely low, and all of that. And there could also be some bunching together of demand. So I think we really don't know the answers how inflation will shape up, but I think US wage inflation and inflation. This is a key monitorable going forward. And if this persists, I think it could lead to higher interest rates world over, which clearly has some implications for India and our capital markets as well. To summarize, I think the world economy seems to be coming back to normalcy pretty soon. The second wave of COVID did not impact the either the economy or the capital markets meaningfully because both households and businesses have learned to operate from the comfort of their homes or in a lockdown kind of situation. So I think unless something really difficult happens, the world economy appears to have normalized and hopefully it will grow at a reasonable pace going forward. And on the other hand, the fiscal deficit and the monetary stimulus should be rolled back. And I think we should prepare for higher interest rates globally. I think let me now share with you one very interesting topic, and this is something that we have been uh, highlighting. Even last year, we had a slide on this. I think this is a very pertinent issue. I am sure some of you must have recently seen how energy prices across the world have gone up very sharply. How crude oil prices, despite the world not really having opened up fully, have gone up very sharply. And even coal prices, which is a dirty fuel, have been extremely high. And there have been reports of shortages of coal. So I think this is an extremely important issue. And our view is extremely simple and it has been very consistent. So if you look at the chart at the top, it tells you how much the world has been investing in new exploration or development of fossil fuels, oil. And you will see that from 2015 onwards, the capex on upstream capex has been below what it was pre 2015. And last year again, it was one of the lowest in last several years. It is important to keep in mind that the natural decline of oil production is around 3 to 4% a year. The flow decreases at that rate. So even to produce the same level of oil, you need to keep on investing. And this fall in global capex in upstream is, I think, worrisome because this raises the possibility that the oil supplies may actually fall ahead of the demand. I mean, we all know that ultimately the world will substantially transition to EVs, electric vehicles. But I think the current trends in the forecast suggest that the oil demand will peak not before 2030. But since oil capex has already declined for the last 5-7 years, we think there is a possibility that the oil supplies may actually peak out ahead of the oil demand. And this could lead to a significant energy inflation. If oil prices go up as the world tries to economize and move to cheaper forms, I think it will lead to a broad-based energy inflation, could be in gas, could be in coal, and various parts of the world are grappling with this. And I think this is a key issue which the world faces. And if this turns out to be true, I think it could lead to higher inflation than what probably bonds are pricing in right now. And this also has some implications for India because higher oil prices are not good for India. Though, of course, unlike the past, when our vulnerability was high, currently the software exports have grown to such an extent and they continue to grow at a very decent pace that our ability to handle higher oil prices has clearly increased. But incrementally, clearly, higher oil prices are not good for India. And in fact, if I may also say here, this view reflects in some of our portfolios as well. And we are overweight some of the energy stocks and which have actually impacted performance for even last year they impacted because the markets have taken a very negative view of the traditional energy companies. But I'm sure, taking note of the recent developments in energy prices, these stocks are doing quite well. And should this, while this higher energy inflation will not be good for the world economy, I think it will be positive for this particular group of stocks. Again, we are not an expert on gold, but since this is a subject of great interest to Indians, and this slide we have included at the request of Ashok. Actually, initially we were not including this, but let me share with you some thoughts around gold. Again, I mean, please, these are individual opinions or opinions of few of us, and we are not experts, so there is no guarantee that these views are right. The gold has generally preserved purchasing power in dollar terms or in whichever currency terms. The top chart gives you the real price of gold, and gold has very long cycle. And currently you can see that the real gold prices are sitting near a peak. And this is why for last few years, I mean, one has been cautious on gold. While there has been a small correction in the real price of gold, but it is very small, and you can see that we are indeed quite close to the peak of the past inflation adjusted gold prices. The chart in the middle tells us as to why has gold done so well. Gold has done so well clearly because interest rates have been extremely low, and a reasonable part of the world has also been facing negative interest rates. And what do you do when interest rates are negative? I mean, households and institutions can move a part of that money to gold, and I guess that is what would have happened. And that is why gold prices have done quite well over the last 3 years. And you can see very clearly in the middle chart, there is a very good correlation between the negative yielding debt and the gold prices. The I think when we talk of the future, I think we are clearly preparing for a world which will see higher interest rates, and whether the real yields are positive or no, we don't know. But at least interest rates look like they will move up, which I broadly think would not be good for gold prices, because as and when interest rates move up, a part of this money which went into gold because debt was not yielding anything or yielding extremely low, I think can move back into debt. While inflation is generally supportive of gold prices, but I think given the fact that inflation adjusted gold prices are already very high, I think even if the inflation persists for a while or is higher than expectations, it may not impact gold prices much. Let me now share with you some thoughts or take a review of what we said in last year's yearbook and what has actually happened. So I think I will not go through this point by point, but I think by and large, things have turned out as we had said in the last year's yearbook, and I would encourage you to go over last year's yearbook if the need be so. So we had said globally recover. I mean, there should be good recovery, and which has happened. We had highlighted risk of inflation, and inflation has turned out to be indeed quite high. We had said gold price outlook is uncertain, and gold declined in dollar terms last year. We suggested that fiscal deficit last year was a temporary blip, and indeed the fiscal deficit is coming down this year quite sharply. It is not going to pre-COVID levels, which I think it may still take 2 years, but I think clearly tax collections have been extremely buoyant, and we expect that fiscal deficit will be around budgeted levels, and it should continue to reduce going forward. We had a slide that crises have been triggers for reforms, and we had given both global and local examples. I think if you look at in India, some very important reforms around the PLI scheme, around the strategic divestment of PSUs. I think some very important reforms have been carried out in this extremely difficult period. And we had highlighted that the equity markets rally was extremely narrow, and which is what had also impacted the performance of equity funds. I'm happy to share that the markets have become extremely broad based, and this is now beginning to help active funds. One thing which we did not get it right was that we had said that long end yields are likely to remain range bound while short end could rise over time. What has actually happened, and both at the short and long end, yields have moved up around 60 basis points. The yearbook goes on to discuss, 4 or 5 key trends around the world. One is of digitization. I mean, we know how banking and commerce are moving to digital means extremely fast. The second, we discussed the implication of the fast adoption of e-commerce in India. Then we have some slides around climate, the debate and climate change, and we have some slides around how does the world go to net carbon zero, some thoughts around energy inflation, and also some slides around electric vehicles. I will not be discussing the slides around the first 4 topics, but very briefly, I would like to mention that the rapid adoption of digital banking, digital payments in India is very good for the large banks. And there is very little which that the fintech can do and which banks cannot do. Large banks that have a large customer base and have the ability to spend large amounts on adopting the best technology, I think will be very competitive. And those banks that adopt good technology will not only be able to service virtually an infinite number of customers, they will also be able to service customers much better. They can service smaller customers much better as loans become digital, services will become instantaneous, and I think the cost of banking will also drop. I think the adoption of digital banking is generally positive for large banks, and they should be able to emerge more competitive. And I think the market share consolidation should also take place faster. And on the e-commerce, I think that has rapid adoption of e-commerce has significant implications for lots of businesses. And there are few businesses which e-commerce will not impact. And so all of us should take note of this, especially the equity investors, as to at what pace and to what extent different businesses will get impacted. I think the increase in e-commerce is also good for consumers for improving the quality of life in tier 2, tier 3 towns in rural areas. Because in these areas, the access to all products and services was not there. And I think e-commerce is taking the big superstores or whatever to these all parts of the country. So I think it serves a very important social purpose as well. On climate, I don't want to say much except that it is an extremely noble objective to reduce carbon emissions, and I don't think anyone has any debate around that. The only issue is what is the reality and how fast and how much can we adapt. I think there are a few challenges in very quick adoption of renewable forms of energy, and that we have dealt in last year's yearbook also and in this year's yearbook also. And I'm sure all of us will keenly watch how this space plays out over the next few years. And recently, a term has been coined, green inflation. I think Ruchir Sharma has commented on this. And this basically refers to that this transition from traditional sources of energy to the renewable sources of energy will bring in significant costs. It will bring in significant inflation, and which is referred to as green inflation. So even I'm a student here, and I'll be keenly watching this space. I want to, however, share with you two slides around EVs, electric vehicles, because this is something there is greater clarity on, and it also has some implications both for the country and for the businesses that we invest in. So I think electric vehicles have probably moved beyond the stage of skepticism. Until a few years back, we used to discuss, debate whether EVs will really happen. I think that stage has now passed. And world over, I think there is increasing acceptance of the fact or of the view that EVs will gain share very rapidly. Chart at the bottom left gives you the estimated EV penetrations of sales, and from a 3% penetration in 2020, it is estimated that by 2025, 18% or 1 in 5 vehicles being sold will be EVs. I think the debate is now shifting to beyond EVs, and we feel the software, the gadgets, the features will be the real differentiators in EVs and the automobile. And here, I think a quote by the VW Volkswagen CEO is very interesting. He says, software will be the key differentiator to decide how successful VW will be in the new auto world. I think this is a very important transition that the automobile industry is facing, not just from ICE to electrics, but also the component of software in these vehicles will grow up, increase extremely sharply. As far as India is concerned, I think our view is that EVs in India will happen faster than we think. The government has been extremely supportive of EVs in two ways, rather in three ways. One, the ICE way, there is concessional levels of taxation for the EV vehicles. That is bringing the price parity to a reasonable extent, or at least it is reducing the price gap pretty substantially. The fossil fuels also continue to be taxed heavily, petrol and diesel, and that is increasing the cost savings when you move from ICE vehicles to EVs. I think higher taxation of vehicles and of fossil fuels, I think, is bringing cost parity for EVs much faster than what would have happened otherwise. And therefore, we think EVs in India are at an inflection point, both in two-wheelers, three-wheelers, and in few years, even in passenger vehicles. So that was just, and this clearly has implications for investments that we make. But I think this transition to EVs also has a very interesting implication for the country, which actually we have not written in the yearbook. As you know, India imports huge amounts of oil. I think it's more than 100 billion US a year, our oil imports. And in the next, let's say, 10 years, when EVs are a reasonable part of our population of vehicles, and we are able to reduce our demand for oil, I think it has the potential to make India a current account surplus country structurally. And when a country that has been for practically all in perpetuity, or at least in last 50, 100 years, that has always had a current account deficit, when that moves, if it moves to a current account surplus, I think it will have extremely positive implications for India, for stabilizing our currency, for reducing inflation, interest rates, for increasing the purchasing power of India, for reducing poverty. And US has had the benefit of a very strong currency for many decades, and it has resulted in high levels of prosperity. And I do hope and wish that sometimes in our lifetimes, as and when India is able to reduce the dependence on imported oil, we also become a current account surplus country. Let me now move on to some thoughts on the Indian economy. And you can clearly see in the chart at the top that COVID led to the first ever contraction in the economy in India. In fact, proudly used to say that India grew even in the year of 9/11 or Lehman crisis, or when Asian crisis was unfolding. But COVID, I think, was an extremely powerful force, and it led to a 7% contraction. Current year, the economy has recovered, but this growth has to be seen in the context of the very low base last year. I think going forward, the growth outlook of India has improved. And I mean, I dare say that the growth outlook of India post-COVID is actually better than it was pre-COVID. Most of the economic indicators like exports, IIP, GST, power demand are now meaningfully above pre-COVID levels. What makes us very positive on the Indian economy going forward? I think there are multiple, I mean, by a good coincidence, almost all the aspects of economy or the many factors have come together and all are favorable. And that is what makes the economic outlook so positive. The table at the bottom summarizes some of these factors: steadily growing consumption, acceleration in infra investments, divestments, strategic divestment by government, favorable regulatory reforms. I mean, just go back few years, and India used to constantly struggle with a decent regulatory framework. So we had challenges in the infrastructure, we had challenges in the coal sector, we had challenges in the telecom sector, we had challenges in the airline sector, we had challenges in the power sector. But look at the headlines today. You don't find any challenging headlines. We had issues around retrospective taxation. I think all these regulatory shortcomings have been addressed, and India today has a very sound, proper regulatory framework, and which I think will be very positive for encouraging investments into this country. We have extremely strong capital flows. Our white collar wages after a long time are going up. And I'm sure you have read how there is wage pressure in India on white collar wages, which I think is very good for supporting consumption growth. Exports are doing extremely well. PLI scheme has great promise. And of course, liquidity conditions continue to be good. So I think there are very few, worrying signs as far as the economic outlook is concerned. The macroeconomic indicators are stable. Current account foreign exchange reserves are extremely high. CAD is reasonable. Fiscal deficit is coming down. We have carried out some important reforms. And I think the manufacturing opportunity for India is a very big one. And we had devoted few slides to this even in last year's yearbook, and even this year I'll be taking you through one slide how the increasing competitiveness of India versus China uh, has the prospect of improving our GDP growth by 1 to 2% a year for many years to come. Startups have come of age. I'm sure all of us read about these daily. There is a small, simple slide there. The outlook for infra, capex, and housing is good. And the consumption, which has been a consistently growing sector, the outlook has improved because of the white collar wage inflation. Let me now share with you one or two slides each on each of these. Fiscal deficit, you can see, has clearly spiked up in the COVID period as government adopted a counter-cyclical, spending to impact help the economy. But I think tax revenues are very good, and despite the likely shortfall on the strategic divestment front, I think the center's fiscal deficit is likely to be under 7% this year compared to over 9% last year, and hopefully next year it will be even lower. Exports are doing extremely well. Our capital flows across all the formats, FII, FDI, private equity flows have been extremely strong, and foreign exchange reserves are now once again touching an all-time high level in relative to the GDP. Some important reforms have been carried out. I will not go through this entire list. You can read it at leisure. But I think the decision to strategically divest PSUs, except in the core areas or the strategic areas, I think is extremely positive. Air India has been done. We hope to see few more divestments this year and hopefully a lot more going forward. Uh, Divestments have been delayed in India, but I think that is understandable because when in a democratic setup, you are doing things for the first time, which deal with public assets, public money. I think there is a lot of learning, a lot of decisions that go into it, and hopefully with one or two transactions, as and when they get done, the learnings that accrue to the people or to the people who are implementing this would hopefully enable much faster progress going ahead. Fortunately, there was no adverse headlines, and there's broad acceptance of this going forward by the people in general, by the political establishment, by the media, and by the workers. I think that's a very no headlines in this case actually are welcome. We have seen some important reforms around the in banking. NPAs are clearly behind us. For many years, we have struggled, but I'm sure NPAs are not making headlines now, which is again good news. Bad bank is in place now. And as I said, the telecom and the power sector, the coal sector, the mining sector, the regulatory framework is sound, and we are not seeing any headlines in these sectors, which used to be the case until few years back. I think strategic divestment is extremely good, and uh, the same companies in private hands. In many cases, they have done well, and we have given you one example of Hindustan Zinc, which was divested in 2002, and other PSU metal companies, and you can see the very large gap in performance. And we have given you an example of how big value has been eroded in BSNL. And there were press reports way back that BSNL was worth 80,000 crores. And you can see how much losses have accrued since then. So I think there is a role for public sector at a point of time. But when there is enough private sector activity, I think the incremental value add of public sector being there is clearly less. And therefore, I think this is a good decision to reduce common stakes, sell off these companies in the non-strategic areas. I think this will bring more revenues to the government. It will bring more dollars for the country whenever the buyer is a foreign entity. It will grow these companies hopefully faster, make them more profitable, make them more valuable. And I think this will be the interest of both the employees and the shareholders. I think let me now share with you one very important topic that we have been highlighting repeatedly for last few years. As you can see, this deals with the manufacturing opportunity, and the last 2 decades were a lost decade for India's manufacturing. You can see how China's share of global manufacturing moved up very rapidly from being very close to India. And India is where it was practically 20, 30 years back. We have hardly progressed. This is a very large opportunity. And now, fortunately, the environment is turning conducive for India to make up uh, for the lost time. So you can see in the chart in the middle, India's manufacturing wages are exactly half of China's, $265 versus $530 per month. And this has happened because Chinese wages have gone up very sharply because Chinese per capita income has gone up much more. Chinese per capita income, interestingly, was same as India in 80s. And today, I think it is almost 5x, 5 times. I think this big gap in wages, Indian and Chinese wages, should work to our advantage now. Our costs are lower, and the disruption to the supply chain caused in a world that was over dependent on China due to COVID lockdown, I think is now encouraging the buyers to develop alternate sources, at least as a de-risking strategy. I think the buyers are keen to develop an alternate source to reduce dependence on a single source. The costs are comparative. Indian markets are extremely large, and the government has a very supportive approach to encouraging Indian companies to capitalize on this opportunity. PLI scheme, the very focused, very targeted, very time bound scheme across various product categories, I think will be very effective. India has the right skill sets. We have the entrepreneurs. We have a very large market, unlike some of our Asian peers who will find it harder to achieve scale based on domestic markets. And once domestic markets give you scale, it is easier to export. Government is also supporting by way of both tariff and non-tariff based policies. Many items, especially in the defense area, have been banned for imports, and anti-dumping duties wherever applicable are also availed of. I think this opportunity is so large, India is so competitive, government is so supportive, and the buyers are keen. I think you can take virtually all the boxes, and I think this is an opportunity that India will capitalize this time around. And this is so large, it has the potential to increase India's GDP growth rates by 1 to 2% a year for many, many years. And this is what precisely happened to China over the last 2 decades. And this was a key reason why the Chinese economy grew much faster than India. So I think our time is coming. And now I think in the next 1 2 decades, India should be able to achieve faster. It should be the world's fastest growing economy, and it should go ahead of China as well. And I think one last chart at the bottom is also interesting. As China has achieved prosperity, and we have seen as people become more prosperous, they become more selfish, and they have less children. And that is what is happening to China as well. And you can see India's working age population will actually cross China's sometimes in the near future. I will not go into this in detail. I will skip this slide. But basically, you can see at the top that manufacturing as percentage of India's GDP has collapsed over the years because we failed to make things. We moved from agriculture to services. We missed the manufacturing opportunity. But hopefully now it will come back. And PLI is a very important government initiative to help us reverse this. I think this is an interesting slide. This is extremely welcome development. And I think successful countries, countries become successful if you are innovative, if you have a culture of startups, new businesses. I think India was lagging until few years back. Startup was not even known what is a startup. But look at it today. Last year, the number of new unicorns in India overtook China. I think this is a historic moment, and the tremendous success that we have seen in unicorns, I think is great news for India. Unicorns bring in innovation, they improve competition in the marketplace, they force incumbents to become better, they deliver more value to the consumer, they create lots of jobs, they create more pressure on wages, and which takes the wages up. And hopefully some of these companies will also over time become global in scale and reach. And of course, these companies create immense wealth for various shareholders at different stages. So the time to become a unicorn has also collapsed, and we have given you some data points. Naukri and Make My Trip became $1 billion company in 20 years. but now in few years, companies are becoming billion-dollar companies. I think these time frames have shrunk for a number of reasons. One, the size of the economy has grown manifold in this period, so the opportunity has become much bigger. The adoption of internet is far more today than it was 10 years back, and that is clearly enabling much faster penetration of these new business models. And even the consumer, I guess, has moved and is adopting to digital much faster. And of course, the capital markets have been extremely buoyant, interest rates have been extremely low. So the availability of capital is also not a challenge for this sector. There could be, and possibly there are some excesses in valuations in that space, but that's okay. I mean, some will make money, some will lose money, but net, I think this is great news for the economy going forward. I think one very interesting counterintuitive development was that the resurgence in corporate profitability. I'm sure all of you will recall and how we used to feel frustrated that the Nifty EPS growth estimated at the beginning of year never materialized for many years. And at the end of every year, people like me would come and say, look, this happened, that happened. Commodity prices fell, NPA resolution took longer. But fact was that earnings growth was extremely poor. And you can, it is interesting to see what happened actually. So in 2008, India's profits to GDP was around 6%. It fell to a low of 1.6% profits to GDP in 2020. This, of course, was driven by multiple factors, huge write-offs by banks, low commodity prices, weak capex cycle. But net, you can see why, despite a growing economy, profit growth never came because margins of aggregate profitability just kept on falling. Well, things have turned very sharply in the last 2 years. And from 1.6% profits to GDP, next year it should go up to 4.5%. So I think what took 10 years to go down is reversing in probably 3 years. I think this is great news because improvement in profitability, especially in the manufacturing sector, has been very broad based. Right from paper, sugar, textiles, metals, chemicals, across industries, I think we have seen a sharp improvement in profitability. And this is happening at a time when corporate leverage, which is the next chart in India, is now touching almost a 10-year low. I think low debt on the balance sheet, good demand conditions, good exports, rising export competitiveness, and the sharp improvement in profitability, I think one can again conclude that the outlook for private sector capex is actually very positive. And we are now seeing reasonable signs of that. Earlier, this used to be merely a hope that cyclical upturn will take place. But now I think there is greater confidence given these favorable factors. Uh, Moving on, I did not hear this, but I was told recently our chairman, Mr. Parekh, said that in his long career of almost 50 years, he is the most positive now on the housing sector. I can relate to that because the reasons are very simple. The home affordability in India has improved sharply, as you can see in the chart at the top. Why is this happening? One, because real estate prices have been stable for a while. And more important, the mortgage rates are the lowest ever. The gap between mortgage rates and the rental yields has shrunk sharply, as you can see in the chart at the bottom, in the middle, from a 5% gap, which is down to 2.2 to 2.5% gap. I think the currently wage inflation, white collar wage inflation that is underway, I think will improve this affordability even further. I think therefore the outlook for growth in this sector is quite positive. This is a very important sector of the economy. It has many backward linkages, cement, steel. It's hugely labor intensive, both for skilled and unskilled labor. So I think if housing revives, I think it will again be very supportive of faster economic growth going. And finally, I think the last slide on economy. I think India has always experienced secular growth in consumption. The rising, numbers of people in EPFO, the improving wage growth, and the low penetration of consumer durables, as you can see in a chart out there, and the improving access to goods and also services in some cases through e-commerce beyond tier 1, tier 2 cities. I think all of this has the potential to at least sustain, if not improve, India's consumption growth rates. So net to conclude, I think the economic outlook of India is, to my mind, one of the best that I have seen in a fairly long time, and is certainly better than it was pre-COVID. So whether it is consumption, private capex, infra capex, exports, housing, I mean, you can probably startups, access to capital, foreign capital flows. I think you can tick all the boxes, and that's why I feel the current decade, the growth rates of India should be meaningfully higher than what we have achieved in the last decade. Let me now move on to equities, and this is a very equities. I've always said is a very simple asset class, though not an easy one. And you can see what has happened. That the markets fell very sharply due to COVID. Markets overreacted. That is what is their nature. And unfortunately, many investors did not take advantage of that. Many local investors. But where are we now today? I think we have normalcy has come back, panic has subsided, and actually the very low interest rates world over and in India have taken these markets beyond what we had anticipated. We were quite positive on the markets, but I think it is fair to say that the current market levels were not anticipated by us either. Where are markets today? I think we are, unlike some people who think markets are very expensive, that's not true. I think as you can see in the market cap to GDP chart, we are somewhere in the middle of the past range of market cap to GDP. It is maybe slightly higher than longer term averages, but I think given the low cost of capital, this is understandable. This is okay. And also, the India is a rapidly growing economy. Our nominal GDP growth, hopefully, current year should grow around maybe 12-14% a year. What looks slightly expensive looks fairly valued or undervalued 6 months down the line as you roll over to the next year. Over long periods in fast growing economies like India, the growth is a far bigger driver of returns than some variation in P multiples on the way up or on the way down. Index has moved from 100 to 60,000 in 42-43 years. And in this period, we have seen many periods of high and many periods of low interest rates. But returns broadly track growth rates. I think while these markets are slightly higher than long-term averages, they are valued like that. And even if cost of capital moves up, multiples may move down, but I think the growth rates should lead to decent outcomes over the medium to long term. What are some of the other factors that are relevant to equities? Clearly, corporate profitability has bounced back very sharply. And in the chart in the middle, in the table in the middle, you can see what I was saying earlier, that we used to see actual earnings turn out lower than the estimate at the beginning of the year. And that happened persistently every single year. And we have listed last 6, 7 years. This changed, I think, last year. And you can see in the chart at the bottom that the earnings estimate for both fiscal 22 and 23 are seeing persistent upgrades. I think this is an extremely welcome change. What is driving this? I think the end of the corporate NPA cycle, one, the improvement in commodity prices, two, interest rates being extremely low, corporate leverage being low. And also, I think in the period of COVID, the organized sector has gained share from the unorganized sector. And more importantly, I think some costs have also been permanently. The one more slide on market valuations. The top left-hand side is the chart is the P multiple chart. You can see the P multiples are slightly above long-term averages. Uh, but interestingly, the chart on the right-hand side, which is the yield gap between earnings yield and bond yields, is near long-term averages. And this is what I was saying earlier, that while the valuations are 10, 15, 5% above long-term averages, we can accept that given the low cost of capital. I'm sure we have read how equities has become from a niche product to a mass market product in this period. Various reasons have made that possible. People sitting at home, more savings, low interest rates, digital connectivity, and low markets. And anyone who invested in last 2 years, I think there has been tremendous positive reinforcement. And what we see today, 8 crore demat accounts and addition of 1 crore demat accounts every quarter, I think is a result of all of that. Domestic flows have been very strong, even in mutual funds. So I think this is again a very positive development, because historically we have seen that whenever adverse global events used to take place, like 9/11, Lehman, Brexit, tapering, Indian markets would experience very large degrees of volatility. I think if these trend persists, that local flows sustain, then I think in the future our volatility due to global events should reduce. And we got a taste of that in the last few quarters when foreigners were actually quite reasonable sellers, but all of that has got stopped by the market. So this, I think, is an extremely positive development. Of course, whenever crores invest in equities, some or many of them may not have good outcomes. I think this cycle repeats itself every 5, 10 years, and every 10 years we have a new generation of investors who will make mistakes, and hopefully next time around they will become more mature and invest in equities in the right way and avoid some of the mistakes what they make in the first time around. As equities have become more popular, I think the supply of stocks has also kept pace. And you can see there is a sharp increase in IPO activity as well. And this again, I think, is good. Some IPOs people may lose money, some they may make money, but I think the supply of higher equity capital to the markets, to the economy, is very important for future economic growth. And I think it will also prevent the markets from running away. This is again a slide that we had shared in the past. I think what has happened is in most years, the returns, the contribution of top 5 highest contributors to Nifty returns has been around 50% broadly. But there have been few outlier years. And by a strange coincidence, we had 3 back-to-back such years. Calendar 18, 19, and 20 Just five stocks delivered 152, 80, and 80% of Nifty returns. And this is what posed significant challenges to active funds because active funds run far more diversified portfolios. And this is what we had suggested even last year. And the underlying message was that as markets become more broad based, active managers should do better. And that is indeed how things have turned out this year. So I think that the weak performance of active funds over 1819 probably was an aberration. Though I must admit that as the mutual fund ownership, or as the institutional ownership of equities keeps on increasing over time, it will become harder to beat the benchmarks. So the reality in future or the outcomes in future will be somewhere in between the past. I think I have one last slide and then I'm happy to engage with you or any. Basically, one last slide on interest rates. I think as we have been saying for a few years and certainly last year, that the short end of the yield curve should move up at some point of time and the long end yield should be range bound. But I mean, I think the key is inflation going forward and global yields. So I think by and large, our view has been that it does not make sense to invest to chase yields by chasing duration and fixed income. And one should maintain a cautious stance as far as duration is concerned on the fixed income. So thank you very much for a very patient hearing and wish you and your loved ones a great year ahead.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.